Living in Reno, Tahoe, we're going to go a little bit different direction today. I have brought in my friend, Kathy McAlpline. She's a senior loan officer at Mason McDuffie Mortgage, and we've known each other and both been in this crazy real estate business for over 20 years. And today we're not going to talk specifically about Reno and Tahoe. We're going to talk about financing and other options. So on this channel, we're always talking about moving to, living in, and visiting our area. And because I pay attention to it in my degrees in finance, we have these loan conversations and things all the time. And so what we want to talk about today is, with interest rates being high, and a lot of people, I think, have a lot of equity in their properties, they're trying to figure out ways to access their equity without actually buying or selling real estate. So it's caused people to kind of stay in their homes longer than they normally would, because like me, I'm under 3% interest. My son has a 3.25%. So we want to talk specifically about HELOCs versus HELOANs and what the difference is and why one would want to use one versus the other. My understanding is, like you said, a HELOC would be me getting sort of a line of credit that I have access to some money for that I could use, and idea would be to pay it back quickly. A second mortgage or a HELOAN to me would be me trying to almost get like a cash out refinance so I could take that cash and go do something else. Am I correct about this?
That's correct.
Okay.
Yes.
And so what would be the reasons why one would want to do one versus the other? And does one cost dramatically more than the other? And is one interest rate dramatically more than the other?
Yes. And to both of those questions.
Yes.
So the home equity line of credit is an adjustable rate.
Okay.
So using it for something small that you were going to borrow, pay back is a perfect purpose. So using that to pay off credit cards would not be a good idea if you're trying to consolidate your debt and pay it off. And that's because your credit card debt is the same kind of debt. It's an adjustable rate. You might be reducing your rate, but a fixed rate loan, which is a home equity loan, like you said,
right.
Cash out, paying off that debt, getting it to zero, possibly closing those credit cards so that you don't incur that debt again, would be a better option.
Yeah, because we always talk about the danger is when people start taking out equity from their existing property is, are they learning the lesson and paying off this consumer, I call it bad debt, versus are they using it to do what? And buy another rental property. You just have to be careful. I always tell people you don't want to use your house as an ATM and live a lifestyle and try to afford things that technically your incomes cannot afford you.
Right.
So these are things we talk about in some of our other videos and we're going to talk more about in the future. But I just think people need to understand the difference between why you would use a HELOC versus why you would use a HELOAN. And you see all these videos about just keep buying rentals and buying investments and stealing your equity and always being at 80%, 80-20 loan to value. And I just think sometimes you're playing a dangerous game.
You are. And on a home equity line of credit, it's an interest-only payment for the first 10 years. And so people get teased by that.
Right.
And so they get used to making that interest-only payment, and very few of them actually pay down the principal.
Right.
And then eventually you'll have a payment amortized over a shorter period of time that either triples or doubles, and people get themselves into a little situation.
What does it matter? So like, for example, and I think some people are talking about getting just a cash out where you say, I'm going to get a second loan, I get a check, and then I can turn around and go use that for something else. Does it matter dramatically to you as the lender what I plan on doing with the money?
It does, and it matters to you as a consumer too.
Right.
Because you don't want to borrow on a home equity line of credit with a rising rate if you're buying a fixed asset like another rental property. You want to try to match your debt to whatever that asset is. So,
right, and I think this is where they confuse people and make it sound like it's so easy. So let's say, for example, on that $600,000 house that has a $300,000 loan, let's say I have a 3% interest rate on it. But now I go out and borrow $150,000, $175,000 at 7, 8, 9%, turn around and use that money to buy another asset that the interest rate then might be 7% because you're always going to pay a little more on a rental property than you would as a primary residence. It's like, you got to look at what all these payments are going to be, and they just go, oh, you just put a 10 in there, it's no problem. They just pay the rent every month. And then I keep trying to tell people it's not quite as simple as that.
And it's not cash flowing.
Right.
So you have to think about that.
Right.
So it's not just what you're purchasing, but what is going to be your cost in that on a monthly basis? You'd have to be in the long game, like you say.
Right. I always talk about the long game.
If you're buying investment property and you're borrowing both your down payment and your actual loan to purchase that property, then it's going to be very difficult to cash flow.
Well, and I know they make it sound like, hey, if I was in my 20s and had to do it all over again, I just go out and keep buying multifamily properties. So loans, obviously for people that understand, if it's 4 units or less, you qualify the same way as you would be if you're buying a single family home. So if you're looking at more than 4 units, then it becomes a whole different ballgame. But for people, let's say they're looking at 4 unit or less buildings, and I were trying to do this, does that even make it more complicated?
It is more complicated, but you can still you can still do it. Your opportunity to cash flow is probably better in that situation than a single family residence, but you're still.
Is this qualifying, like the qualifying part, I know on some of them, they let you use the rental income. Let's say I moved into one of the 4 units and rented out the other 3. I realize they're going to let you count some of that income as part of the qualifying process.
Yes, exactly.
Okay.
Yes.
Okay. So I was curious about that because then I hear the new buzzword, which I didn't know. I think it's a DSCR loan.
Right.
So why don't you tell people kind of what that is?
That's a debt service loan
Right.
where you actually don't even have to have your own cash flow, but you cash flow just on that particular property.
So how low a down payment could I come in if I try to use one of these loans?
Typically 20 to 25%,
Okay.
but your interest rate's going to be a lot higher.
Gotcha.
Yeah,
Okay.
so interest rate is set based on risk.
Right.
So the less documentation you're providing, the riskier the transaction
Right, because they
is.
show it to you saying that, you don't need any, what the thing I keep hearing is you don't need any of your own money to qualify, meaning I go get an equity line or a HELOAN or a HELOC off of my existing house, use that money as the 20 or 25% down payment on a DSCR loan, and technically I didn't have to come out with any money out of pocket. But I always look at it as when you start stealing your equity from your primary residence, you're sort of not coming out of pocket, but you're coming out of pocket.
Yes,
I mean,
you
that's
are.
kind of equity that you're stealing from yourself to go buy something else. And this is, for those who don't know, we've both been doing this a long time, where in 07 and 08 and 09, where the qualifying process for loans back then was such a problem, where you saw people get over leveraged and they really caused themselves a problem. So I always tell people, when you're taking equity out of a property, I'm not saying paying off debts or buying other property is a terrible idea. I'm just saying you better be damn careful about what you're doing with this money and not over leveraging yourself, because you still have people out there thinking the market's going to crash, the sky is falling, it's just a matter of time, rates are going to be 12% and everyone's going to go broke, when I don't think that's going to happen, obviously, but you just have to be careful. And so if I were using these loans and I was going to try to pay off other debts, is that looked at differently than using it to go buy a rental property?
Well, it's not looked at differently from the underwriter's perspective,
Okay.
but from the consumer's perspective, yes, because if you're buying a rental property, you want to have a fixed interest rate.
Right.
And if you have a credit card and you're paying 20%, which is, what they're looking at right now in credit card rates as a minimum,
Right.
You can take on a home equity line of credit,
Right.
fixed rate loan, you can actually amortize that out over 30 years
Right.
and cut your payments in half or more.
Well, and again, that goes back to, I think, sitting down with somebody and saying, if I'm dramatically in debt, and I'm talking about bad debts, like you said, student loans, car loans, credit cards, those kind of things, and you're able to then take equity from your house and borrow the money at 7 or 8% rather than paying 20% or whatever rate you might have, it's just being disciplined and smart about doing those things. And I know we try to talk about a lot of financial literacy things on videos that I do, because I think a lot of people are just very uneducated about these topics, and we're going to talk more about some of those. But I just think people have to understand, when you start stealing equity from your house, and if all of a sudden I talk to you 2 years later and you went right back to another car loan and more student loan
Exactly.
debt, and you're just using your house like an ATM, that's a horrible way to go.
It is.
So when you're starting to hear about all these products, whether it's HELOCs, HELOANs, DSCR loans, you see people doing adjustable rate mortgages as well, and they have them for 3, 5, and 7 years. What would be the pro or con of why someone would want to do an adjustable rate mortgage? Because I think some people get that confused with the 2-1 buy down loans that you're hearing
Right.
people do as well. So kind of explain to people what the difference on that might be.
Well, it depends on the type of adjustable rate. If you're doing a fixed rate like 3, 5, or 7, or even 10 years, then your loan adjusts after that period is over. Some of them do have a cap on them. Most people are doing those because they're planning on refinancing. And when you look back last year, we all thought that interest rates would be much lower this year,
Right.
and they're not,
No.
because we can't anticipate what's going to happen. We do know that the government's going to continue to raise rates as long as the inflation is continuing to rise. So none of us know when we're going to be in a recessionary time frame, but rates will come down. So when you're doing those short-term fixed rates, is what I call them,
Right.
then, or hybrid adjustable, the plan is that you're going to refinance out of it. It's not going to be a long-term loan.
Is there much difference in the interest rate or the cost of the loan if they're doing, I come 3-1 ARMs or 7-year ARMs? So basically, for people that don't understand, is you get that rate locked for those 3, 5, 7, 10 years. And then typically, like I did one on my very first house 25 years ago, then once a year, the rate would adjust. We were lucky at those times when I bought my first house. Part of why we did is we knew we weren't going to live in that house more than 3 to 5 years, and the rates were like 9%. So we did it knowing, okay, we're locked in, I think, for 3, and then that particular loan had a 1% per year cap. So it only could go up 1% at a time. And we knew by that point we'd be able to afford it. We weren't going to live there more than 5 years. We were going to move and do it that way. So I think as long as people understand what they're getting themselves into, but do the rates and costs adjust much if it's 3, 5, like if the number of years is different?
It does.
Little bit.
The starting rate does adjust.
Okay.
But what you have to think about too is you don't know what you don't know in the future.
Right.
And
Right.
and I kind of wanted to go back to that home equity line of credit
Right.
because that's what got people into some trouble, because they have this line of credit that has an interest-only payment, and when that interest-only payment time frame is up, they're doubling, tripling their
Right.
payment because they have to now pay a principal and interest payment.
Right.
And sometimes it's at a higher rate than what current market rates are, and they can't refinance into a 30-year fixed rate.
And I think all these programs have their place. I just think a lot of times people don't understand them, or they're getting bad advice from someone who's not been doing this for 25 years that can explain to them, here are the pros and cons. And part of that would be you asking me, what is my situation? If I knew I had moved to Reno, wanted to buy a house, and I knew I was only gonna live here for 3 years and the rate didn't matter, I was selling the house and moving anyway, then you might do that because you get a little lower rate or a lower payment, those kind of things. Or if you were, this is the big thing you've been seeing lately, is the 2-1 buy downs.
Right.
And I keep explaining to people, that's great. You got a lower rate for the first year and the second year. But if you're not comfortable with that actual payment when you start year 3, knowing that we could wake up 2 years from now and rates are even higher,
right,
you better be comfortable with that rate. And yes, I understand you're betting on or hoping rates will be lower and you could refinance. But this is the other thing where people understand is those early first 5, 7, 10 years of your house payments, you're paying mostly interest anyway. And if you keep refinancing, you're never going to build up a bunch of equity in your house unless prices dramatically go up, which over the last 10 years they did, but I just don't see dramatic appreciation happening over the next 3 or 5 years. Assumable loans. This is another buzzword I've been hearing a lot. This was something when I was a kid back in Las Vegas that my stepdad used to basically pick up some homes on assumable loans. So it's a topic I keep hearing people doing, or seller financing. If someone's looking for these type of situations, or you've done loans that were assumable, what would be a typical assumable loan?
FHA and VA loans are assumable.
Okay.
And then I don't think there's anybody left out there, but if you had an original conventional adjustable rate loan, those are assumable too.
Okay. And so how would that work for a buyer? So I keep trying to explain to people, let's say 3 years ago, I bought a house using an FHA loan and I put 3.5% down. And now I've got, let's say $40,000, $50,000, $60,000 worth of equity in this house. What does that person coming in trying to assume that person's loan, what kind of money do they need to make that happen?
Well, the difference between what the balance is of the loan and what you're purchasing the property for is how much you have to come in with cash. And you're dealing with a loan servicer at that time. So you're not getting your own loan. You're actually going to their current lender and negotiating the actual contract with them.
And are you seeing, I'm sure you've obviously done lots of FHA and VA loans over the years. Are you seeing a lot of these loans that are technically assumable actually being assumed, or lenders saying, I don't want to do this?
I don't see it because it's on the servicing side and I'm on the origination side.
Right.
So I get a lot of inquiries about it.
Right.
It's really up to the servicer on approving. You're qualifying in a little different manner.
Okay.
And I had an actual servicer on a VA loan that said that the veteran couldn't actually come out of the deal with any cash.
Okay.
So how do you put together a transaction where you've got a buyer, having to come in with a difference and the seller trying to sell for more than what they purchased it for?
Right.
Well, that doesn't work.
And the older, like I said, the older these loans are, the bigger that spread's going to be between the value and the loan amount. So you're going to need a lot more money. So when they say, hey, just go out and find an assumable loan, if you're a first-time home buyer or someone really young that's trying to just scrap together a house payment or a down payment, it's probably pretty unlikely you're going to be able to go find something that's assumable.
Right.
But seller financing is a different animal. And so I think the stats show like 45% of all homes in America that are primary residents are owned free and clear. And for a lot of people that might be older, they may not want to sell their $800,000 house and get a check for $800,000. They may say, hey, I'll be the bank.
Right.
And I think people don't realize that all that really happens is if someone owns their home free and clear is, they're just becoming the bank. We use third-party companies that then make it so I pay not directly to the seller, but there's lots of options out there. So if you're someone who's watching all kinds of content all over the internet and you're trying to figure out between assumable loans, seller financing, HELOCs, HELOANs, regular mortgages, there's a lot of different loan products and ideas. What would you tell people before they ever go do some loan that isn't just your standard 20% down conventional finance that you see people do?
To get the information, because what happens is they're getting solicited, number one, for financing if they're looking at anything online, homes, anything having to do with purchasing a home anywhere. And those solicitors are salespeople. they're not
out your best interest.
No, they don't have your best interest at heart. So you want somebody that is going to live where you live, that knows people that you know and is an expert and has been doing it for a long time.
So Kathy and I, our rule always is we are always going to do what's in the best interest of the client, whether it means telling somebody not to buy or sell right now, or to let them know, hey, you should do an equity line, you shouldn't, whatever the case may be. I have one other thing. It just dawned on me. This is kind of one of my funny things. I always love to talk about Dave Ramsey stuff.
Mm-hmm.
And Dave Ramsey's big thing about housing, especially for your primary residence, would be before you ever buy a house, you should have no debt. So no car loan, no credit card loan, no student loan, no medical, but zero debt. You should have 20% down, and you should never do more than a 15-year mortgage. We're having people having a hard time qualifying right now on minimum down 30-year mortgages. How many people are actually going to be realistically be able to come in with 20% down, 15-year mortgage, and have no debt? Like, how many applications do you see like that?
Very few. Very few.
Right.
But I do see a couple every now and again.
Right.
But you can qualify. You don't need 20% down.
Right.
You can purchase a home with 3% down. You can purchase a home with 1% down with assistance. So you just need to call and we'll sit down with you and look at your individual situation and find out how we can get you into a home.
And it goes a lot more into just the financing part of it. Like we always talk about, we want to know what your story is, meaning if you're planning on living somewhere or buying a house and being in it for the next 10 or 20 years, then coming in with more of a small down payment and somewhere you're going to stay longer makes more sense than if you said, hey, I'm only going to be here for a year and I'm moving out of the area and I want to keep it as a rental. Well, then there's just different things and different stuff you need to be having conversations with us about. Reach out. We'll give you the answers to the questions so that you can feel like you are getting honest, true answers. And again, we both do enough loans and sell enough homes that we're not going to force someone to do something a lot sooner than they're probably fully capable of.
Exactly.
There you go. That's all our loan stuff. I just wanted to make sure if you guys have questions, by all means, reach out to us, give us a comment. We're easy to find, both of us on the internet. This is Kathy McAlpline at Mason McDuffie Mortgage. And if you're enjoying the content we're putting out there, by all means, hit the subscribe button, ring the bell, send us your questions. We'll be happy to answer anything, and we'll see you on another video very soon.